Ladies and gentlemen, good day and welcome to Zydus Wellness Q3FY22 post-results analyst conference call hosted by Ambit Capital Private Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal for an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Alok Shah from Ambit Capital. Thank you, and over to you, sir.
Thank you, Zed. Good evening, everyone. Good morning to the people joining in from the western part of the world. And on behalf of Ambit Capital, I would like to invite you all for the Q3FY22 earnings call of Zydus Wellness. From the management side, we have Dr. Sharvil Patel, Chairman, Mr. Ganesh Nair, Director, Mr. Tarun Arora, CEO, Mr. Umesh Parikh, CFO, Mr. Nitin Parekh, CFO from Cadila Healthcare, and Mr. Vishal Gaur, Senior VP, Corporate Finance, Cadila Healthcare. Without further ado, I would like to hand over the call to Mr. Tarun Arora for his opening remarks, and then we can go ahead and open the Q&A session. Over to you, sir.
Hello. Good afternoon and welcome to the post-results teleconference of Zydus Wellness Limited for Q3 financial year 2021-22. As Alok has already introduced the participants, I'll move on to the details. During the Q3, our company posted a year-on-year growth of 2.3% on net sales. The lower sales growth is largely due to two reasons. First, due to lower growth on a high base during previous year's comparable period, which was accentuated by a slowdown in rural growth. Secondly, as we are implementing a continuous replenishment process internally as a part of integrated business planning tool, we have reduced inventory both internally as well as in the trade channels. This would help us to operate with leaner inventory and better availability of fresh stocks to the consumers. As the country and the FMCG industry is reeling under the impact of inflation in the prices of key raw materials and packing materials, the company continued to face the pressure on gross margins. To mitigate the impact, the company has taken 2 rounds of price increases during the last 2 quarters, which will help the company improve gross margins in the coming quarters. As the third wave of COVID has hit India during the last half of current quarter with a very sharp rise in cases with state-specific curfew and timing restrictions imposed, the company was quick on implementing the learnings from previous COVID waves and is in a better position to tackle the supply chain and other operational challenges. Due to COVID, there was a disruption in the non-essential category. However, essential products like sugar-free, Complan and Nutralite helped the company to stay on course. We continue to support the online sales through the third wave as we have seen higher demand on these platforms. Going forward, post the third wave, as things return closer to normal, we would plan to enhance our direct distribution by another 1 lakh outlets. The company has been taking several measures to safeguard its workforce from the effect of pandemic. The company adopted hybrid model of working, giving freedom to employee to work from home in these times. Let me take you through the highlights of the consolidated financial performance of Q3 financial year 2021-22. During the third quarter of financial year 2021-22, our total income from operations grew by 1.7% to 3,881 million rupees. EBITDA was down by 34.8% year-on-year to 323 million rupees. PBT before exceptional items was down by 36.7% year-on-year to 227 million rupees. PBT after exceptional items was up by 1,205.7% year-on-year to 27 million rupees. Net profit was up by 1,239.1% year-on-year at 233 million rupees. With that, let me share some of the highlights of operations for the quarter gone by. We continued our thrust on marketing initiatives to grow the categories and increase market share of our brands during the quarter. To narrate a few, on the Glucon-D front, during the quarter gone by, Glucon-D Immunovolt continued to deliver steady business while core business delivered flat growth. On the Complan front, the Complan relaunch was supported with its new campaign, Umeedon se aage badhne ka plan, which communicated the key benefits of the brand, 2x faster growth and improvement in memory and concentration. This was amplified by 360-degree media campaign on TV, digital, impact properties and influencers across the country. The relaunch was also supported by consumer promotion to establish mental growth association with the brand and generate trial. On sweeteners front, Sugar-Free brand continues to air its new thematic communication, Fitness Ka Pehla Kadam, through TV and digital mediums across markets. Sugarlite grew at a high double digit during the quarter across all channels, supported by consumer promos and TVC. On the personal care front, Everyuth brand continued to grow at a good double digit, supported by ATL campaigns on scrub portfolio and new body lotions range. On the dairy and spreads category front, Nutralite brand delivered yet another quarter with good double digit growth. The Nutralite Doodh Shakti Probiotic Butter Spread and Nutralite Choco Spread were continued to be supported with TV, digital and print media campaigns. As per the MAT December 21 report of Nielsen and IQVIA, Glucon-D has maintained its number one position with a market share of 58.1% in the glucose powder category. Complan has a market share of 5.2% in the health food drink category. Sugar-Free has maintained its number one position with a market share of 96.0% in the sugar substitutes category, which is an increase of 104 basis points over the same period last year. Nycil has maintained its number one position with a market share of 34.0% in the prickly heat powder category. Everyuth Scrub has maintained its number one position with a market share of 39.2% in the facial scrub category, which is an increase of 448 basis points over the same period last year. Everyuth Peel Off has maintained its number one position with a market share of 76.4% in the peel off category. Everyuth brand is at number 5 with a market share of 6.5% in the overall facial cleansing segment as well. As we speak, we have completed 3 years of acquisition of Heinz India Private Limited. Over the last 3 years, despite losing sales in critical months for 2 consecutive years due to COVID, we have consolidated and grown our market shares across categories, launched multiple innovations, doubled our direct distribution, made significant strides in growing our business ahead of the category in both online and offline organized trade, reduced cost to serve, and simplified the organization, leading to exceeding our synergy targets. The biggest challenge which we face is the recent inflationary pressures across commodities affecting our margins. With the actions in place, we should be able to overcome these challenges with the ongoing quarter 4 of financial year. The country is witnessing downward trend in the COVID cases, and which will have a positive impact on the consumer demand sentiments going ahead. This will help the company to protect the sales of summer season quarters spanning across January 2022 to June 2022. Thank you, and we will now start the Q&A. Over to Alok for the Q&A.
Can you take over the Q&A? Yeah.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Yeah, thanks. My first question is on Complan. So what would be your long-term target for distribution scale-up? You have done 1 lakh more distribution since acquisition, but what would be your 3-year target? And second, in the last 3 years, how has the market share been in Complan? You mentioned current market share, but how has it been versus 3 years back?
So let me answer the distribution at 2 or 3 levels. So first of all, Complan, yes, when we acquired, it was about 4.3 lakh outlets. We've crossed the 5.5 lakh, 5.7 to be precise, as reported by Nielsen. In our availability reach as per Nielsen, my view is 8 to 9 lakhs is what we would aspire, but that will follow as the brand grows. I think this was basically catching up to the fair size of our brand. Rest of the things will also have to follow. We're also focusing on driving direct distribution, which will help us, our NPDs and quality of distribution, making all our products available. We started with 2.5 lakh direct distribution, each of the businesses before acquisition. We've crossed a 5 lakh. Our vision for a direct distribution in the next 3 to 4 years is to cross 1 million, which is suitable for our size and portfolio, for which over the next few quarters, we are looking at adding another 100,000 outlets. This will obviously have a ripple effect on Complan distribution also. So that's answering the Complan distribution piece. Second, your question on market share. At aggregated level, Complan market share for last years has been in the range of 5.5. It has slightly reduced this year. We are at 5.2. I think there's a drop of 15 to 20 basis points over the same period at MAT level, but this is also a function of multiple segments that Complan plays. So there has been a little bit of that, but largely it's in the same zone as we.
Two follow-ups there. On double-digit sales growth in Complan, do you have confidence next 3 years, if there is no very serious wave 3, you expect double-digit CAGR in Complan next 3 years? And on the NPD launch, Complan NutriGo, how differentiated is it? Is it a big NPD or is it one of those smaller NPDs?
So our aspiration for Complan has to have a double-digit growth. We've seen the category operating at 5 to 7. So that's the challenge, and our wish list is to grow faster than the category, and that's why we believe it can do that. Our focus and priority will be on a volume-led, getting new consumers. And if led by some of the leader in the category who've been reducing prices, if we have to act, we will act. So at a volume level, our clear aspiration is to be a double-digit growth trajectory over the next 3 years. Yes, and we believe our actions are in place or will follow it through. As far as extensions are concerned, NutriGo is clearly differentiated on a superior formulation vis-a-vis the competition. It is a higher level of protein than the top players in the segment on toddlers. Also has a better mix of proteins, which is more suitable for a toddler, closer to the mother's milk, inspired for the mother's milk, with the right mix of protein and milk. So we have the right formulation. It's going to be a little bit of slow burn because the route we have taken is the healthcare professionals, and COVID has certainly impacted the healthcare professional reach out for a lot of consumers. So it may have a slow burn, but we have a differentiated offering, and we believe we have a good journey ahead with Complan NutriGo.
And one more
I have one more point to add. This is Mr. Patel here. So, Sharvil, hi. So, 2 more points to what Tarun alluded to. One is, as we said, that Complan is definitely differentiated the NutriGro product, which will go to the medical fraternity first. And we believe it will definitely be this year with the normalcy coming back, we can see a big jump in terms of our revenue for that. And it will definitely become one of the large brands in that category that we're trying to highlight. The second part with respect to can we see a Complan double-digit growth, one thing that we have definitely seen is the better proposition that this the formulation offers versus the competition. Already in modern format and other formats which are more of the regularized formats and which are growing, we have seen a double-digit market share there versus our single 5% market share in the overall market. So I think if everything goes well and if we do our right things in terms of science and also making sure that we give the right proposition, which is higher protein and higher, better content of protein, we can definitely see a double-digit growth being driven by this product.
One last follow-up on Complan. So in FMCG, there is a threshold market share in any category before which your profitability really is there. In your case, mid-single digit kind of market share plus 3 years, the market share has not really moved much. So is it profitable, and at what level market share aspiration would be there, given single-digit market share, mid-single-digit market share is quite low in FMCG. There are fixed costs, advertising spends.
So it is profitable, and I think there are two ways to look at it. We don't talk about it, but really speaking, this category is sizable. In fact, Nielsen still underreports it, but Nielsen number is 6,500 crores. And if you look at broad, if I give you a high-level three segments, so there is a toddler 2 to 6, then there is 7 to 15 kids, which is a large play where the TG for most Complan and key competitors is. And there is the adult space, which is again fragmented, women's and adult, and there are new players coming in. Now, the mid-level of the market, which is 75%, where we have the main play, I think standalone will be a 8% play, and this is a sizable category. I don't think we can generalize all these parts from there. And this is a profitable brand, and we are growing in we are building state-by-state strategy, and we are seeing some traction on that. So I think it is above that threshold to confirm to you, and profitability is quite okay.
Sure, that's all from my side. Thanks a lot.
Thank you very much. Next question is from the line of Shirish Pardesi from Concall Capital. Please go ahead.
Yeah. Hi, good evening, Dr. Sharvil, Tarun, good evening, and the team. Two questions, taking from the previous participant's question. This high science, or what we say that adult nutrition, and you did mention that the category size is 6,500. How big is this category in terms of adult nutrition? And maybe if you can say that what is the growth rates which are there in this category as an industry?
You mean the overall 6,500 crore category is growing last, the Nielsen number, they're revising their estimates, but the last number I had in November was about 1.5-2% for 3 years CAGR or 2 years CAGR. Last year is growing at 5 to 7%, 6,500. The different segments are growing at a differential rate, but last year has grown by about 5-6%.
I got that, Tarun. What I was simply saying that the adult nutrition, especially the NutriGo.
Adult nutrition is growing at a much faster. Adult nutrition is growing at a much faster pace. I think, on a CAGR basis, it will be about 7 to 8 versus 1.5 that I talked about on the overall category. So it is growing much faster.
Okay.
And toddler space in last 5 to 8 years has grown much faster. Last 1 or 2 years, the numbers have dropped. That also because this whole toddlers has a healthcare professional angle to it, and access to the healthcare professionals has really got reduced, especially even for the kids because of the fear. So that category has been under pressure. The category has also been in a negative space in that case in the last couple of years.
Okay. My second question is that if we have grown only just 2% on a YY basis, which category or subsegments has declined on a YY basis? I mean, you did mention that some products has a higher base, but if you can just give a little more color where we are seeing the decline.
So we've seen we've actually two reasons, as I explained to you. We have on a primary sales basis we have numbers reduction across 2 or 3 brands, including we've had growth largely led by Everyuth and Nutralite because we've also reduced the inventory, as I explained to you.
I think majority also, but is Complan, which I think will correct from coming quarters onward. But Complan have definitely had a challenge in the earlier quarters, and also some of the inventory related to the seasonal products which we need to clear for fresh billing also led to that challenge.
I got that, Sharvil. My follow-up on that, you did mention in the beginning that there was inventory correction which has happened. But at what level we are comfortable in terms of inventory correction? Is largely it is done, it is behind, or there is further more correction which will, because the last 2 quarters we've been saying that there is automation which is going to be taking place.
So we've done inventory correction both in the internal numbers where we've reduced almost by 7 days, and as well as with the distributors. Now, we may not need to do anything substantial or anything specific going on. I think this can be handled. This also got necessitated given that we have to build up for the season. So we had to act now. Better to act now than later. And that's one of the things. So we're largely done, is my belief. We'll see as it goes now. So there's no major other things planned.
I think what has happened for us is the inventory correction has been more than the other years, because this year we expected a normal season, but April, the second wave, took us all by surprise, and it was even worse than the last 2020. So I think that is the reason we had a little bit higher correction, but I think that is a one-off, and we don't believe that from FY23 we would see those kind of corrections.
Okay. My last question is on the international. Especially, you have said in the presentation that you want to grow to 100 crore next year. Just little more deeper, which countries, what products, and what is the opportunity which you would try to get? 100 crore in so many countries, what you have shown, is still looking less number, but I want to get little more deeper insight which all products we are exporting and how the growth, or maybe which are the countries which are topping, because you did mention that top 5 markets contributing 80% of the business.
So our aspirations are much larger. Our aspirations are that it can be 8 to 10% of our business in next 3 to 4 years. 100 crores is something we should be able to cross in next 1 year, and therefore I would say that would be our execution plan for me and the management team to ensure we cross that milestone. So it is managing the portfolio, and we have a portfolio of brands and we have a portfolio of countries. Fortunately, there are some countries which are clearly emerging as more promising and have showing a stronger depth. So those 5 countries constitute a larger portion of business. Sugar-free Complan are also showing a better promise in these markets. So they constitute a major portion of our portfolio, and therefore will allow for, extensions and going deeper and wider in these markets. That's the broad thought on this. First of all, there are countries we've just established our subsidiary in Bangladesh. Bangladesh is clearly a country of interest to us, and we believe we have an exponential growth opportunity in that, and we will be investing behind that, starting with maybe setting up a third-party manufacturing line as well to support that initiative. We've also seen Middle East responding very well, and Nigeria responding very well for us. There is New Zealand, which is a little far away but has been doing okay for us. So these are some of the countries which constitute this, but Bangladesh, Nigeria, Middle East, more so of the eastern part of Middle East, if I were to say, the UAE side. I think that those are the geographies which are looking stronger response, wider portfolio, and getting deeper. And we have extensions planned. We have a new launch and extension planned by end of this quarter itself coming through.
So I think what Tarun also said, our midterm plan is to get that 8 to 10% of our revenues driven out of export, which was insignificant for a period of time. I think our 5-year plus vision is to definitely create 1,000 crore exports international business, and I think we're sort of making sure we start off well with our first milestone. And as we are prepared for that larger opportunity, we will definitely discuss that as we prepare the strategy for that. But currently, we hope that about first half, in the first few years, we believe we should target a 8 to 10% kind of market of overall Zydus Wellness business in the exports over the next 3 to 4 years.
That's really very helpful. Just one last follow-up on the you have mentioned just now that there is a third-party manufacturing which we are looking at establishing in GCC and New Zealand. What is the thought process behind this, and which are the products which we are seeing will have the benefit of having this manufacturing outside?
So these are largely Complan production places that we are using in GCC as well as New Zealand, and we are setting one in Bangladesh. Partnering with somebody to set it up in Bangladesh. We will add more products as we go along.
So we already have these manufacturing other than Bangladesh already done. We are just going to add Bangladesh as another additional country now.
Okay. Yeah. Thank you, and all the best to you and the team.
Thank you.
Thank you. Next question is from the line of Kapil from Edelweiss. Please go ahead.
Hello. Sir, our Nutralite sales have been growing well over the last few quarters. I believe these new launches such as mayonnaise, choco spread, and even now ghee must be shaping up this growth. So what are our expectations here and how big this portfolio can become?
So Nutralite is now coming together with the convergence of what was actually a byproduct business of Heinz, plus our own fat spreads. So we're clearly creating a brand which will have a larger play in both dairy as well as spreads. But dairy is leveraging our existing capability of the Aligarh plant, where we source milk from 25,000 farmers and we use it for Complan. Also, Nutralite lends very well to building to a value added. So in dairy, our wish list is to play only in the value added products. So the way we see it is, we'll rather be in ghee or butter, or maybe some other new dairy based spreads we could evaluate, which we are working on. Mayonnaise and chocolate, early days, but we are seeing good traction on mayonnaise. More so also in the food service side. So all these will go across both in retail and as well as food service. And the way we are carving out is that a new route to market retail will merge with our rest of the business, and the Nutralite sales team will focus largely on the food service, and we'll widen our portfolio. Standalone, it is due to convergence, the brand looks almost twice the size of what it was, but largely it has come from the convergence of two coming together under one umbrella of Nutralite. But we are also seeing good traction on the fat spread in last few quarters, as well as mayonnaise in the food service space. Ghee is also building up and butter is also building up steadily. I think this brand can be a sizable portion of our portfolio, be in the top 3-4 brands for us.
So I think maybe if I can add to what Tarun says in terms of our strategy and plan, definitely with the with Nutralite being expanded into adding value added from dairy side also, I think we see tremendous potential for this brand. This brand definitely has the potential to be the largest in terms of sales for the organization over the next few years with the traction that is going through. I think with the right segmentation that we've done on the professional range, the HoReCa food services, and separating it from the retail side, which is very different, I think all of that will also help in terms of the strategy, in terms of how to move the brand forward in this segment. And also, very importantly, what we have realized is that many of these products will form part of the daily requirement or daily household needs from the brand Nutralite point of view in terms of consumption. So I think once we execute all of this right, this can be an important lever in terms of revenue growth for the organization. And once it achieves a certain size, then definitely it can be one of the largest brands for the company. I think the profitability will improve over that period.
Thank you. Thank you so much. That was really insightful. My next question is, in your investor presentation, where you have mentioned breakup of your channel mix, this others contribution is quite significant at almost 1/4 of the overall pie. So which products would be getting supplied through this channel, and how are the margins stacked up here as compared to other channels?
So if I were to give you a sense about 1/3 of that is in food service HoReCa, therefore it's largely Nutralite. A little bit of sugar free, but that's 1/3 Nutralite. Another 1/3 would be closer to will be government channels, which is basically CSD, CPC, etc., where the margins again are in line with our retail channel. And there is a little bit of other things that will add up. But mainly these are two key drivers of the others. About 16 to 18% out of, I think, 22, 23 what we would have seen.
So apart from Nutralite, it would be other products like Complan Glucon-D also, or how it would be? Like Sampriti ghee would be there, but then...
No. In the food service HoReCa, it is what it constitutes is largely Nutralite brand, sugar-free. Nutralite will have some bit of ghee, butter as well. Government channel has Nutralite, has all the brands, which is Complan and ghee and sugar free, all the brands. So it's a CSD CPC channel. Most of the margins in government channel are in sync with the margins we earn in the retail. A little bit here and there. Some brands are a little higher, some are a little lower, but largely in sync with the other margins.
Okay, sure. Thank you. Thank you for the clarification. Thank you so much.
Yeah. Thank you very much. Before we take the next question, we would like to remind participants that you may press star and 1 to ask the question. The next question is from the line of Nilesh Shah from Envision Capital. Please go ahead.
Yeah, I have a couple of questions. One is in Nycil, what is the market share? Because in the presentation, somewhere we've mentioned as 37%, somewhere it's mentioned as 34%. In our press release, it's mentioned as 34%. So is it 34% or 37%?
So volume share is 37.4, value share is 34. So so there is a gap in value and volume, and in the presentation we have explained we've moved from 29.1 to 37.4. Our focus has been recruiting new consumers to volume-led initiatives. One of the things we have realized is that maybe the opportunity to price up exists, and therefore there is a gap between value and volume share, and we'll try to work towards closing this gap in the next coming quarters.
Thanks. Second is on the export side, which are the products or which are our brands which are doing relatively better? I mean, we probably export all our products or all our brands. So is there any specific product or brand which is doing better for us in the exports market?
So 90% of our business is between Complan and sugar free, and both are doing meeting or exceeding their targets. Sugar free comprises sugar free base brand, as in the sweeteners, as well as the chocolates which we sell in Middle East and now some other markets as well. The sugar free franchise and Complan, and both have been meeting and exceeding the numbers. We are hoping that we'll be able to add on some of the brands in the portfolio. We do see some opportunities where Everyuth is doing better and has an opportunity in Bangladesh. We're taking some of the other products elsewhere, Nutralite in some markets. So, but the flagship for us remains between these two brands.
Okay. And lastly, on margins, given that we are approaching a couple of quarters, which essentially, of course, are important quarters, and last year in the same quarters we had operating margins or EBITDA margins of about 24%. Given that the business environment is a bit sluggish for us, and we are facing headwinds in terms of inflationary cost pressures, do you think we should be able to get to that 24% operating margins for the upcoming quarters, or that looks a bit of a challenge for now?
I'll give my point of view, Umesh, if you want to add, but in my opinion, I think we have a little bit of higher operating leverage in quarter 4, quarter 1, because 60% of our planned sales typically come from this quarter, and much higher portion of our margins come because the cost structure is remaining same. It delivers a higher profitability. So I personally believe we have taken actions that we had to, because our pain area has been gross margins due to inflation. We have taken action in terms of price increases. So unless there is a mix issue, a product mix, or some other external factors, I largely believe we have a good shot at meeting or exceeding our EBITDA margins in the coming 2 quarters, which are very, very crucial for us to deliver our each financial year's numbers.
Great. Thanks. And
so let me, Nilesh, I think just to also clarify further on that. So I think, other brands Complan definitely has faced challenges. Other brands have been very steady. And I think this year what we will see in the quarter 4 and quarter 1 is last 2 years we were disrupted because of COVID, and brands like Nycil and Glucon-D obviously could not do their regular business. I think that will be a big upside this year because we had a very big loss of base in the last 2 years. And we have, at least on the margin side, a good margin structure on those 2 brands, and we have covered for some of that, either through price increase or buying of raw materials. So I think if everything goes well in terms of our plan, I think this quarter 4, but more importantly quarter 1 will be very important. driven by obviously these two brands, which have obviously struggled last year because of COVID, last 2 years because of COVID.
Great. Thank you so much and best wishes for the upcoming quarters. Thank you.
Thank you very much. Anyone who wishes to ask a question may press star and 1 at this time. Next question is from the line of Praveen Sahai from Edelweiss Financial. Please go ahead.
Yeah, thank you for taking my question and thank you for a detailed presentation you had shared. So my question is, as you have mentioned in the presentation, for double-digit growth in profitability led by innovation. So my question is, in the past, company has launched new product across segments. Is it possible to share any directional even it will work? How much of the sales generated from especially specific from the innovative new product you had launched in the past?
So products launched in last 3 years have contributed to close to 2.5-3% of our sales. Our wish list is to be 5. So we are building towards 5. We started at a lower level once we integrated the business. So we still have a path to go. Some of the innovations that we launched a flurry of innovations in financial year. 2 or 3 of them have not will not see forward. We'll drop them. Some of them have good potential to grow, and therefore our priority right now is to build on innovations that we already have in the marketplace, to take them to the logical conclusion and grow them faster. And we believe some of them are really good to go and have enough founded. And going forward, we will be looking at probably 3 to 4 launches in a year, 1 to 2, not more than 1 or 2 max launches in a year, in a quarter, and build around those in a sizable manner. So my wish list is that we should cross 5 to 6% of our business coming from products launched in last 3 to 4 years, and that would give us that we're not just launching products, but we are seeing enough momentum in the following years as well. Maybe if we get there, we can be more ambitious as well, but I think it's also raising the bar constantly. I think there is some journey ahead to improve our innovation potential.
Yeah. Thank you. And these innovative new products have a higher margin as compared to existing ones?
They are largely in the same zone. It varies from product to product. Sometimes they could be even higher. If I were to look at some of the examples, like we launched body lotions, the last one, they are largely in sync with the heavy use overall category. Maybe a few percentage points lower to start with, but we also, as we build our learning curve in procurement and manufacturing, we've seen that some of these products also we get better.
No, but I think, Tarun, answer the question. Yes. From whatever we've seen, majority of them will have same or better margin.
Yes.
Okay, great. And especially on 2 of your products, you had mentioned in the presentation, one is Immunovolt, which is around 28% of market share. So can you give some color on how big the market size is and competition is especially there?
So it's very small. We are looking at widening our use cases. So there are some players already in that space, but the category has not grown or was growing at a small pace earlier. And that's why while we can be happy about 28% in a space which is about less than 100 crores, 60 to 80 to 100 crores. But the point is, grow this space and grow it sizably will be most important for us. And that's really what we will be looking at building on this.
And in the Nycil, as you had mentioned about the 37% of a volume market share, is that also include your new product which you launched in the Nycil category, like a body mist and all?
No. Mist is not included in that. But mist is hardly anything because we launched in March and April, May, due to wave 2, it got we could not get much value for it. So, even if I added it, won't change anything substantially.
Okay. Thank you. Thank you for taking my question. All the best.
Thank you. Next question is from the line of Akash Shah from UTI Asset Management. Please go ahead.
Hello, am I audible?
Yes.
Thank you very much for the opportunity. I would just like to ask, what is the contribution of Sugarlite to overall sales, maybe for FY21 and this quarter?
So at last trailing 3 quarters YTD level, I would say it is operating at about 7-8% of sugar-free 8%, and it's growing much faster.
Thank you. And a similar number for international business. I mean, what is the contribution to overall sales right now, maybe 9 months FY22?
Last trailing quarter will be about 3.5%.
Sure. Thank you. And what would be the gross, let's say, as of December 2021?
So gross debt is 315 crore.
That's it. Thank you very much, and all the best.
Thank you so much.
Thank you. The next question is from the line of Alok Shah from Ambit Capital. Please go ahead.
Yeah, hello sir. Thank you for this opportunity. Tarun, I wanted to check your thought process on how do you plan your investments in building brands. And this especially is because Zydus is the market leader in most of the categories except the HFD. So does some brand take precedence over others, and which will be those brands which where sort of like a power brand for you at this point in time?
So fortunate. I mean, for our size, and I believe we are at a size where we've not had to take a call one brand versus other or priority one brand versus other. If you look at the presentation that we've shared on the past 3 years and our journey forward, each of the brand has a good double-digit growth potential. And therefore, it is not a situation where I have some cash cow sitting that I'll milk it and not build on it. Some brands may be delivering, may to some investors or some stakeholders may feel that they have more potential, but largely if you look at the potential of each of the brands, each one has sufficient room for growth and penetration. There is a use case which appeals to a large set of consumers, and therefore there is a growth opportunity. It's just that the solve for each of the brands is different, and their margin profiles and the approach is very different. So far, we've been able to optimize our needs for each of the brands without having to take some hard calls. The hard calls of prioritizing one over the other comes only at the time of innovation, which typically, again, I look at 3 levels. One is the incremental innovation, which the brand P&L will pay for. There are platform innovations which need a little bit more money, but only for 1 or 2 years. And there are breakthrough or large innovations which we believe have a longer play and may need some habit changing and will probably need investments a little harder and a longer break even. A good example will be Sugarlite. So we will in a given point of time try to not take more than one odd big innovations, but most of the other innovations we'll have to balance within the brand budget. So we are kind of so far being able to balance it, but we do, for example, have some thoughts in the pipeline, so we will balance it out. But largely, I think most of the brands, I feel we are sufficiently resourced to drive our growth. Being the leader, it also becomes that much harder if there are many people. So it cuts both ways. One, if you are alone, yes, you have the disproportionate share, you have a pricing power, but it also limits your opportunity of how you can grow the brand at a faster pace, which multiple players together by investors make it. So this is a kind of challenge we face, but I think we are well resourced and we are doing whatever it takes for each of the brands.
So I think if I can add to what Tarun also said, I think it's 2 things, right? One is because we are market leaders in majority of the segments, there are two options for us to increase the opportunity size. One is to have more use cases. So brands like Sugar Free and Everyouth and some others need to create more use cases. And then somewhere is we are not participating in certain segments of the brand. So there, in terms of Complan, right, we only present in toddlers and certain other segments. We're not in the adult segment. So I think we have to look at segments and see where we are missing in terms of the brand. And largely, when we look at our spend, it is a mother brand concept that we follow. So, when we are doing, I think there is a rubber effect on the overall brand when you are doing some kind of promotional activity. So looking at both of those things is how we are trying to take a call when we're talking about a new introduction. Going forward, one is because of COVID also. Another thing, I think the number of new introductions will need to be limited, and a few more impactful launches will make more sense to do as we move forward in this coming year.
Got it. My second question was on the distribution. So post the acquisition, we of course seen the benefit of distribution expansion. Any quantification that whether all your portfolio is now able to seamlessly move in the new distribution? So basically, it's a depth versus breadth, right? So where will we be on that front now?
So distribution, I think a lot has been said in terms of our outlet reach, which is more than doubled. Our number of towns, we have gone up by almost 1.5 times. We are focusing adding more stores as we go forward, both in urban as well as rural. So we believe we have some distance to go, but we'll have to be balanced because growth and distribution have to go in, and expansion has to be ahead of what the current situation is to pave the path for the future growth. I think we have been able to access all the sub-channels because our brand portfolio is such that all the sub-channels play out, whether it is grocers, the pharma, the cosmetics, the food stores, and standalones. The pan kiosks is the one place which has not been very important for us, fortunately, and therefore that can be much harder to work for some companies it was. But we've been able to grow each of these parts very well. One of our key focus right now is to drive our range productivity across this portfolio, and that's really the initiative post expansion has been. So how do we increase our range? And therefore we are using a series of measures in terms of measuring those, as well as our Salesforce automation is also helping us track this and use better use of data to address where the gaps are and keep working at it. We have assortment plan by sub-channels, states, etc. That helps us making a product better available at the right place.
Got it. So, basically what I was essentially alluding to is that now with say Glucon-D, you are able to reach new distribution areas. Are you been able to push your other brands also in that new retail outlet that you have got through the Glucon-D? And if yes, to what extent? And from our 6 brands, to what extent we would be able to reach?
A good example is Everyouth. Everyouth has seen in the last 3 quarters. I think in the wave 2, like all brands, and it being non-essential, it got very badly impacted in April and May. But post that, it has come back so strongly, and we've seen high double-digit growth across months. And even when we have, like last quarter, we have reduced, for example, we were talking about production and it impacted all brands. It has continued its momentum. So we've seen a good one of the brands that has gained out of this portfolio. Actually, it impacts all brands. Even within Glucon-D, it is not just about Glucon-D being large and therefore it is driving. Our ability to place some of the, like this Volts was existing earlier also. When we relaunched with the Amino Volt with a larger distribution, we've been able to get our way through. So it is not just the big brand, but there are SKUs within brand which are important and strategic in nature. We are able to push through those as well. So that's the benefit of having a better direct distribution. Wish list is to cross 1 million in the next couple of years.
Got it. And lastly, one bookkeeping question. What would be the blended price hike that you would have taken at the portfolio level, and now in line with the current inflationary scenario, do we think that most of the price hikes required are taken, and we'll take a pause at this point in time?
We will take a pause at this time. We have taken the price hike even during the December, and earlier prior to that quarter we also taken one more price hike. So I think this is now pause for the price hike. If required and if inflationary pressure continues, then we'll take the call at that time.
So what Umesh is explaining is the price hike taken in December to take care of the costs for this quarter, which is in operations. We've covered ourselves for our focus of the costs.
Okay, got it. Thank you very much. Thank you. Then we can move on to the question.
Thank you. The next question is from the line of Nirman S., a private investor. Please go ahead.
Hello. Hi, Sharvil, Tarun, this is Nirman here. It's a real pleasure to talk to you guys after a long time. My question is regarding future strategy. So we've got a good portfolio of brands. We've got a good team. Of course, we've got our hands full with all the different initiatives in each of the brands. And then hopefully over time with Sugarlite and Nutralite adding more, contributing more to the business. The business is already going to be throwing off about 300 crores of free cash flow, which will hopefully continue to increase. So while we are executing on all these fronts, strategically, are we also looking at deploying that money in terms of inorganic expansion? So do we have any thoughts there?
So on the inorganic, right now our focus is to look at more bolt-on and fitting into our portfolio kind of approach, where we're looking at products which fit into our wish list, both from personal care, but more importantly, if something fits in food and nutrition, will be important. We're also looking at some of the key market international acquisitions, and we will looking at those. So
I think
we are conscious of that.
To that point and to what Tarun said is right. So one is definitely on the nutrition side, we believe that protein is a protein area of protein related products are very critical, and especially with the movement that you see on the e-commerce on certain new types of products. I think we are seeing that as an opportunity area to acquire something and build an e-commerce as well as from an e-commerce to a direct distribution play. And we look at brands that we could acquire or businesses, or looking at making sure that they have better gross margins, so that we don't want to buy something that is lower on gross margin side. Also, building an international business is an important area which we can, I think of doing over the next 2 to 3 years. So any areas on that we would be looking to see if we could acquire. So I think those are the two immediate ones. Beyond that, I think currently, as Tarun has said, internally we still believe we have a lot of opportunity to grow these mother brands. So I think the focus will be to make sure that we do so, but we'll keep our eyes open for any opportunity to acquire.
Thank you so much.
Thank you. Anyone who wishes to ask a question may press star and 1 at this time. We would like to remind our participants that you may enter star and 1 to ask a question. Our next question is from the line of Akash Shah from UTI Asset Management. Please go ahead.
Thank you for the follow-up opportunity. I just would like to ask, are we planning to enter any, or does the management team have any thoughts on entering, let's say, adjacent categories over, let's say, next 2-3 years or maybe 5 years down the line? Just any thoughts there? This is just coming from, we are planning to expand our international business, but certainly there is a lot of scope in domestic business. So any thoughts there? Yeah.
So let me say this, that we believe domestic has enough scope and our existing brands have enough scope. We will be looking at core businesses of each of these brands to grow because we believe there is enough potential. There are some, adjacencies within these brands which are possible, which have potential and which will fit in very well with our portfolio, and we will look at growing them through innovation from an expansion point of view. So that's really our primary focus. Even in international, we are seeing it as an extension of the same thing. We learn from each other and pull this together. There is enough opportunity to grow on that. The bolt-on acquisition is only to fit in and give us if there was a quick progression in the spaces that we would like to be. That's largely how we are looking at it.
Sure. Yeah. Thank you.
Thank you very much.
If there are no more questions, we could wrap up.
Hello?
Sure.
All right. As there are no further questions, I now hand the conference over to Mr. Alex Shah for closing remarks. Over to you, sir.
Thank you. On behalf of Ambit Capital, we would like to thank the management of Zydus Wellness for giving us this opportunity to host the call, and to all the participants for taking time out for the call. Thank you.
Thank you very much, members of management. Ladies and gentlemen, on behalf of Ambit Capital, that concludes today's conference call. Thank you all for joining us, and you may now disconnect your line.